Hi, welcome to this week's Brain Boost. In this video, we wanted to have a look at how the system will handle expenses that have been prepaid by the employer, but it's really up to the employee to properly code that expense to the correct project or cost center when they do the expense report. So I've already set up that scenario in the system, and I just kind of want to walk you through the mechanics of how this works. So in this screen here, we're actually looking at a fairly deep setting in the system where we've set up the various expense types. And you can see that we have an expense type called flight paid by company. And if we were to look at just a regular flight, you can see that there is no offsetting account for the paid expense. So if an employee were to choose this expense, the assumption is this system would pay the employee back for their entire flight. If the employee is choosing this option, then all that's happening is the employee is recording on the expense report, yes, I did in fact take this flight, you paid it on my behalf. And if there's an adjustment to the cost center, the expense report should handle that. And so we can control the general ledger accounts that this flows through. And in this particular case, we're saying that both of these are coded to travel expenses. It is mandatory that this offset account is an expense account, so you cannot code this to a liability account like employee advance, for example. So you would have to have this coded to an expense account. And where is that coded? Well, if we go into our chart of accounts and we look at that particular travel account, which was general expenses for travel, we can see that that is coded to account 500-300 travel expenses. So that's the underlying structure that's supporting this. Now let's look at a transaction where this was in play. So let's start out with a supplier invoice. So I created a supplier invoice back on March 1st, and we knew that Edward had to travel, so the company went ahead and paid for his flight. They paid Concorde Travel $1,000. And if we look at this invoice, we could actually drill down on it a little bit. The person in the accounts payable department assumed that because this is for Edward, and he's in the finance department, this was costed to the finance cost center. And so the net effect of that was to create a payable to Concorde Travel and book something to the travel expense account. So in this case, we're using the same GL account that you saw in that expense report. Now, a number of weeks later, Edward came along and he created an expense report. And his expense report looked like this. He indicated that, yes, he used that flight for travel. It was paid by the company and it was worth $1,000. And he's also putting in an expense claim for a hotel. Now, what I want to point out here is when he coded his expense report, he actually changed the cost center and he coded this to the legal department. Did that in both cases, and this could just as easily have been a project code, so very useful if you're doing project accounting, and it's not until the expense report is being done that you know which project those expenses are going to be coded to. And if we look at the overview of this, we can see that the reimbursable to the employee is only $200 because of the way he coded this expense report. $1,000 was prepaid by the company. So those are the two events that happened. Now, as a result of those expense reports getting approved, the invoices getting paid, a number of journal entries were triggered in the system. So just to sort of wrap this up, let's have a look at those journal entries so you can understand all the mechanics of this. So our earliest journal entry was this supplier invoice. So as I mentioned, $1,000 was debited to the travel expense account. And you could see that the accounts payable person assumed it was the finance department. And then the payable was set up for $1,000. And so that supplier was paid. And then we can see that at the end of the month on 03/31, he came in and created his expense report. So Edward's expense report indicated that he had $200 that was owing to him that was not prepaid. And so that expense report debited $200 to travel expense. And this time it's using the legal department. And then it is indicating that there's a $200 payable that needs to be set up for Edward. So now accounts payable can just go and do a regular payment run and it will pay Edward his $200. And then this additional thing happened. So because Edward had claimed that there was $1,000 on his expense reports that were prepaid, the system knows his home cost center is the finance department. So it's actually done a journal entry to back $1,000 out of this finance department and code it where it belongs to the legal department. So in effect, reversing this entry that was done here, where the accounts payable also assumed that it would come out of his home department. So that's important to understand. As I mentioned, this could easily be a project code as well. And so this is how the expense report is essentially reclassifying those prepaid expenses. It's just a matter of training your employees to update their expense reports properly. Thank you.